In this video series, we're going to be looking at the sources of state revenue with a specific focus on the sales tax. Okay, boring pie chart time. We can see that state governments get most of their money through intergovernmental transfers, sales and gross receipts. These primarily refer to sales taxes, charges and miscellaneous receipts. These can refer to user charges, and individual income taxes as well as corporate taxes. In this video, we'll primarily go over sales tax as well as income tax. But let's first start with the big chunk of the pie, intergovernmental transfers. Simply put, they are funds from one level of government to another. The federal government gives money to states, and in turn states pass that money on to local governments. This form of financing is actually a very fascinating topic that I'll probably hope to someday cover in another video. But let's move on to the tax that most of us deal with every day. While the federal, state, and local governments all have some form of tax on goods and services, the sales tax has the largest effect on states because most states are dependent on them for revenue. So how does a sales tax work? Well, it's generally a flat tax on all goods and services that you buy, but it's not as easy as you think. Let's take the case of Pennsylvania, which has a 6% tax on any goods you purchase there. But then in addition to that, local governments in your state can also leverage a tax as a means of collecting revenue. In the case of Pennsylvania, it can go up to 2% depending on the area you live in. This brings the tax up to a total of 8%. This table from the Tax Foundation shows the rankings of states based on sales tax. You can see once you add the local tax rate, the rankings can change. In this map provided by the Tax Foundation, we can see how state and combined local tax rates throughout the different states range from low to high. In general, most services are not taxed. The only states that do tax services are Hawaii, New Mexico, and South Dakota. If services are taxed in other states, it is on a limited basis, because taxes on services are extremely unpopular. So if that's the case, how are goods taxed? Well, generally speaking, goods are divided into different categories, although the exceptions within these categories are usually codified in books that would take years to understand. For the purposes of brevity and simplicity at that, we shall say goods can be classified as groceries, prepared food, aka restaurant food, prescription drugs, non-prescription drugs, clothing, and people who invest too much in brony paraphernalia. Okay, kidding about that one. Fortunately, we have the marvelous, although perhaps slightly outdated table from Wikipedia that gives a general summary of how states choose to tax goods, and let's just say there are many rules. Most states are sensitive to the fact that many items make up a large percentage of low-income and middle-income families' budgets, so they don't like to impose flat taxes on all items. As such, many states will not tax groceries or prescription drugs, or they can alter the tax rate for other items. Let's take the case of Minnesota. While it may not tax groceries, prescription drugs, or clothing, it still taxes non-prescription drugs and raises the tax rate on prepared food to 10.775%. Massachusetts will not tax groceries or prescription drugs, but it will tax prepared food and in this case raise the rate to 7%. It will also tax all clothing purchases after $175. Meanwhile, the state of Illinois will tax all types of items including groceries, prescription medication, and non-prescription drugs, but at a lower rate of 1%. Taxes on prepared food are raised to 8.25%. Confusing? Wait, it gets more interesting. In this podcast from NPR, they go over many intricacies of the tax code and how states sometimes struggle with figuring out what to tax and what not to tax and whether things fall neatly into different categories. I'm putting a link in the description below if you're interested in exploring more of the complexities associated with the sales tax. Meanwhile, I decided to explore the state of New York's Department of Taxation site to see if it was true. You can see here there are all sorts of rules and restrictions about what exactly can be taxed for food and even types of candy. This is the sort of stuff that makes me want to scream at states for having such a ridiculous system for collecting revenue. Not to paraphrase Avril Lavigne, but seriously, why you gotta go and make things so complicated? Now I put in this graph here to show the breakdown of revenues for states and local governments. The reason I put this colorful chart here is not just to expound the merits of data visualization, but also to emphasize that all states and their respective local governments have a diverse array of mechanisms to raise revenue. While states try to remove certain taxes, it's not because they don't have money. but more because they want to stay competitive to residents or businesses, or they might have some other sources of income. Of the 50 states, 5 states collect no sales tax. These are Alaska, Montana, New Hampshire, Delaware, and Oregon. Okay, moving on to a less interesting tax, the state income. Like sales taxes, states have options on how they can implement an income tax. You can see in this graph from the Tax Foundation the breakdown of states from those with the highest tax bracket rates to those with no rates at all. It's important to note that the way states employ income taxes can vary. Some states employ a graduated income tax similar to the way that the federal government taxes income. California has 9 tax brackets, while Virginia has 4. Colorado, on the other hand, has a simple flat tax on income. Furthermore, if you lived in a state that has income taxes like California, but you work in a state like Texas, which has no income taxes, you may still have to report that money on your California tax return. Or, if you lived in Texas and worked in California, you'd have to file a non-resident return for your earnings. I know, total bummer. Now, as you can see from the chart, there are 7 states that have no income tax and 2 states that only tax interest and dividend income. Sounds like a sweet deal, right? Nope. With every lack of tax, there's a trade-off. Some states get money from other sources of revenue, such as oil companies or company and corporations. States with no sales tax can sometimes rely on revenue from neighboring states who come by for shopping. Or they may just have higher income taxes. States with no or limited income tax may have higher than average sales tax. In other cases, states with no or limited income tax may have higher property taxes. Finally, there is the case of state corporate taxes. I'm not going to go into much detail about them because they make up a very small portion of most states' revenues. This is primarily because many states try to offer a lot of incentives and tax breaks to a lot of corporations as a means of luring jobs. Happy corporations translates into a lot of economic activity, which is obviously good for states. This American Life did a fascinating study on different governors and their promises to create jobs, and what they found was that most states don't actually create jobs. Rather, they offer tax breaks and other incentives to steal jobs away from other states. The important point is that as a result, corporate taxes for the most part make up a very small portion of state revenue. Okay, in the next video, I'm going to go over some other sources of state revenue, notably the inheritance tax, taxes on casinos and lotteries, and some of the challenges with state collection going forward. Stay tuned. Like the channel? Want more video updates? Or do you just want my social security number? Be sure to subscribe.